There is a hidden expense in business insurance known as ghost coverage. This happens when an employer pays steep premiums for a policy they fully believe they are exempt from. In the state of Nevada, corporate officers fall directly into this trap. Under the Nevada default rule, the state automatically includes corporate officers in mandatory workers' compensation coverage. The financial clock starts ticking immediately. Premium is calculated and owed on the officer's wages, starting from day one of the policy period. Many business owners operate under a specific, highly damaging assumption. They believe that holding a 100% ownership stake in their corporation automatically negates the need for this coverage. Ownership percentage actually triggers nothing on its own. The state requires a formal notice of election to be excluded, filed directly with the insurance carrier. That form has a strict barrier to entry. An officer must hold a minimum ownership threshold, typically 10% or more of the corporation's stock, simply to have the right to apply. If an officer operates their business assuming they are exempt, but lacks an approved filing on record, they carry zero workplace injury protection, while remaining fully exposed to massive retroactive premium audits. Assuming the rules do not apply based on ownership status alone is the single most expensive error a Nevada corporate officer can make. To see exactly how this penalty triggers, consider a construction company owner in Las Vegas. He held a 100% stake in his business and operated under the assumption that his total ownership provided a blanket exemption. Because of this assumption, he never filed the notice of election to be excluded. The breaking point occurred on a job site. While working alongside his crew, the owner suffered a severe knee injury. The insurance carrier evaluated the claim. Because no legal exclusion form was on file, the carrier was obligated by state law to cover the owner's medical expenses and weight replacement. Fulfilling that claim triggered an immediate financial backlash. The carrier system automatically launched an audit to recover the missing premium for this newly discovered employee. This minimalistic ledger tracks a standard 3-year timeline. Under normal conditions, the timeline moves steadily forward, but the injury event abruptly halts this progression. The audit snaps backward, applying a retroactive premium assessment across years 1, 2, and 3. The carrier calculated this retroactive premium against the owner's full 6-figure salary for all 3 prior years. The sudden, enforced lump sum assessment completely wiped out 3 years of the company's carefully built profit margin. Avoiding a simple 1-page compliance document based on a false assumption ultimately cost this business far more than the standard insurance premium ever would have. Understanding the penalty of noncompliance is only the first step. The strategic question is figuring out who actually benefits from filing the exclusion in the first place. Let's look at Profile A, the passive officer. This is an investor or silent partner who rarely, if ever, performs physical work on a job site or factory floor. For a passive officer, the default inclusion means they are paying a steep premium for a physical risk exposure that simply does not exist in their daily routine. Contrast this with Profile B, the active officer. The active officer regularly visits job sites, works directly alongside employees, and performs manual tasks. This matrix plots the exact outcomes. The horizontal axis measures active versus passive roles. The vertical tracks coverage inclusion. Passive and excluded is the optimal saving zone, but active and excluded is a zone of extreme financial danger, leaving working owners totally unprotected. If an active officer insists on choosing exclusion, they have a strict mathematical calculation to make. They must weigh the precise workers' comp premium savings against the strict coverage limits of a private disability policy. The exclusion document is not a universal hack to save money. It is a highly specific financial lever that must perfectly match the officer's physical reality on the ground. Implementing this strategy requires strict adherence to the mechanical constraints of the application for exclusion. This horizontal policy timeline maps out the absolute timing rule. Once an approval date marker is placed on the record, the coverage exemption flows strictly forward. It is purely prospective and never retroactive. A newly filed exclusion cannot erase past months or years where an owner incorrectly assumed they were exempt. There is also a hard entity limitation. The 10% ownership threshold and these specific default inclusion rules apply explicitly to corporations. Operating an LLC or an alternative corporate structure completely shifts the playing field. Those entities operate under entirely different statutory rules and carrier filing requirements. Even minor corporate restructuring poses a threat. A change in ownership percentage during the middle of the year can inadvertently invalidate an existing perfectly valid exclusion. A perfectly executed exemption strategy instantly fails if it is applied to the wrong entity type, or if the paperwork is filed a single day after the policy period begins. The primary defense mechanism against these catastrophic retroactive audits is an aggressive annual policy renewal review. Step 1 requires identifying every single corporate officer and verifying their exact current ownership percentage. Step 2 requires confirming directly with the carrier that an active, approved exclusion form is currently sitting on file for each eligible passive officer. Employers must constantly reevaluate for changes in circumstance. If a previously passive officer has recently increased their active operational involvement, their exclusion status needs immediate review. The system does allow for reversal. An officer who previously elected to be excluded can file a new form to re-enter mandatory coverage. However, re-entry operates under the exact same timing rules as the exclusion. It is entirely prospective and will absolutely not cover injury sustained while the exclusion was actively in place. The actionable rule is simple. An owner shifting from a passive investor role to an active field worker must finalize their re-entry filing before resuming any hands-on work. Pull your upcoming Nevada renewal list today. Initiate the necessary exclusion filings before the new policy period locks in and begins calculating premium. In Nevada's workers' compensation system, assumptions destroy profit margins. Only a verified, time-stamped paper trail can guarantee your financial protection.